You guys, good morning. Today we have an extra special topic, part 2 of our How to Trade Divergence lessons. So the first part that we did was very basic, and it was the first lesson we did, and so it wasn't my favorite. I decided we're going to do it again. We're going to do it right, and we're really going to go through the dirty details of it. So if you guys enjoy this video, please give it a like, subscribe to the channel. We do daily videos, educational segments, and a lot of technical analysis. So anyone interested in learning to trade, this is the channel for you. Let's get into it. Dang, I have that problem again. I have the problem again of I'm in the way. Oh well. Alright, so you may notice some differences from this video to the first one, and I hope that this gives everybody a better idea. You guys who watch daily know that divergence is, in my opinion, one of the most important things to look for when trying to spot trend reversals or continuations, or really just for trading in general. So in this lesson, we're going to go over the two different types of divergences, the different classifications of those divergences and what they mean, and then we're going to go hit the charts because nothing really looks too spicy today. We'll take requests, hit the charts, and we're going to be looking for divergence all day, so stay tuned. The first type of divergence is reversal divergence. In the first segment, we just kind of did divergence overall, and so we're going to actually break them down into the two types, and the first one, reversal. So reversal divergence is important because unlike yesterday, we did how to trade stock RSI, and we talked about how stock RSI not really the tool to use when trying to find trend reversals. Well, reversal divergence is a great tool for just that. So let's start with the first one, strong divergence, or you may hear people refer to it as Class A divergence. So each type of these divergences that we'll go through, strong, medium, and weak, Class A, B, and C, are a relationship between the price, between the market, or the asset's price, and what the oscillator is showing. The oscillator doesn't actually matter that much. You really can use almost any oscillator and these rules will still apply. That's what's really cool about this. And you can get into combining different oscillators, looking for these divergences across them, and you can use that to strengthen the evidence of the reversal or move that you're looking for. So strong divergence. What we'd expect to see in all bullish divergences for reversal is we are comparing the low points of price action. So in the example of a strong bullish reversal divergence, we would see price sell off, have a short-lived rally, and then sell off again to a lower low. Because this is reversal, if it plays out, we would expect then price to move back up. And this red arrow is going to signify that this is a lower low, that price action is moving down. On our oscillator, we're going to see something a little different. We're going to see the oscillator swing low with the original low, move back up with the rally, and then put in a higher low. We're going to signal that with a green arrow, showing that the indicator was moving up, the lows were coming up. So for a strong bullish reversal, price is setting a low with a consecutive lower low, while the oscillator is showing a low followed by a higher low. We're going to go through the bullish ones first. Medium medium bullish reversal divergence is the same setup. As we said, when we're looking at bullish reversal divergence, we're looking at the lows. So price action, that's a low, rallies, and then sets an equal low before rallying again. We're going to use this blue arrow to signify that these lows are equal. And what we'll see on our oscillator is the same thing as with this the strong divergence. We're going to see the oscillator swing low, rally, swing, put in a higher low, and move up. So that gets the green arrow. For the weak bullish reversal divergence, of course, same thing. We're looking at the lows. So price is putting in a low, rally, lower low, and then reversal, hopefully. The point. And because these lows are consecutive lower lows, we're going to take this red arrow. And on the oscillator, you're going to notice some overlapping here. They're all different setups, but there's a similar pattern to them. Hopefully you guys watching out there live kind of pick up on this as I go. The oscillator swings low, rallies a little bit, and swings to an equal low before reversing. Of course, earning the blue arrow. So what's really great about this is these are really helpful for detecting reversals when we're in it, when price is in a downtrend or market's in a downtrend, assets in a downtrend, because they're going to show a difference or a divergence between the price action and what the oscillator is reflecting. And at the end of this, we'll get into something really important that I've never seen written anywhere about divergence. So stay tuned to this end of the episode to catch that. It'll make more sense once we get through all of these. But yeah, I don't know. I've never heard anyone put this information out, and it seems really fundamental to this whole concept, because I remember learning about it and I just was very confused because there just seemed to be a piece of information missing. And so we'll get to that. All right, bearish reversal divergence. So here we're going to be doing the same thing as bullish, and you're going to notice a pattern and look kind of similar, but this is going to be the opposite. This is going to be a market that's in a uptrend, and we're going to be looking for signs to go short, signs that the market uptrend may be ending or pulling back. So strong bearish reversal divergence, or class A. And we're going to be comparing the highs here because this is all about reversals. That was even confusing to me in the beginning. I was like, you know, we're going up. Why can't I find divergence that's going to make us go up more? It seems like all of these divergences are really pessimistic. They're always going the wrong way. So bearish divergence is going to be comparing the highs because it's looking for reversal, the same way bullish was comparing the lows, looking for reversal to move up. Strong bearish divergence, class A. We're going to see price set a high, pull back, set a higher high, and then again we're looking for a reversal, so hopefully then sells off. And we're going to get ourselves a fancy green arrow to put up there. And on our oscillator, what do we expect to see? We expect to see the oscillator move up with price, pull back with the dip, and then move up with the second rally with the higher high. But the oscillator isn't agreeing. The oscillator says, no, this is a lower high. We're going to place the red arrow. If my computer will cooperate anyway, we'll place the red arrow. And so I think this is pretty logical here. Is your oscillator's kind of telling you about the strength or what's going on behind the scenes of this price action of the buying and selling. And so price is saying, hey, we're going higher, but your oscillator is saying, well, you're not gaining momentum. So you may be putting in a higher price high, but you're not getting that expected increase in momentum that you should have as you set consecutive higher highs. So that makes sense that this is a bearish signal. This is a signal of potential reversal. Your price is moving up, but it doesn't seem like you have more buyers, or at least you're not attracting buyers at the same level as you were at the previous high. Medium bearish reversal divergence, or class B. Gonna look the same as this bullish one, but of course we're comparing the highs now, not the lows. So price sets a high. I don't like that line. Price sets a high, pulls back, attempts that same high, and moves down. We actually talked about this similar pattern yesterday in our three reversal patterns. You can probably remember that's a double top, same as the bullish reversal, double bottom. But there's a little more to this. It's going to give us a little more information here. We're going to have the oscillator swing high, pull back, and set a lower high, just like in the strong bearish divergence. Something of note here that maybe I skipped over is, so these technically don't have to be higher highs, or for medium, they don't technically have to be a like double bottom or double top. What they are is, it has to do with the shape as well. Sometimes this is referred to as V, like a V top would be a bearish, medium or class B reversal divergence, and a V-shaped bottom would hold true in the same sense for the medium bullish reversal, class B divergence. But I think it's easier just to organize in your mind to think about it as a double top, because it differentiates between the three classes of divergence. So it could be double top, but it could also mean that the top or the second high is actually just a sharp move up and down, making a V. Okay, I don't know if that helps. Okay, and then finally, weak bearish divergence. Again, we're looking at the highs. We're seeing price move up, pull back, move up again to a higher high, and then again reverse, because that's what we're looking for. And what we're gonna get is, and this color coding is hard for a colorblind person, but I figure this helps everybody else out, so I'm doing my best. Green arrow, because higher high. And what we're gonna see in our oscillator is the opposite of over here. We're going to see a swing high, a pull back, and then the same high before stopping, earning us a blue arrow. And so what you can kind of take away of this in a simple sense is, the weak reversal divergence is essentially a double top or a double bottom on the indicator itself, with a corresponding lower, higher, high, depending if you're looking for bullish or bearish. And the medium is similar to that, except that it's the price we're looking at now to set that double top or double bottom, or the V shape specifically. And you'll see they really are just the same thing, except price and oscillator are switched up. Okay, so we knew most of that. We clarified a little bit from the last episode, but now we're going to get into the second type of divergence. So there's reversal, and then logically, you may guess, there is continuation divergence. And this is my favorite. This is my favorite divergence. You may have heard it referred to as hidden divergence. And that is correct. Technically, I don't believe it has any class or other name. We just call it hidden bullish divergence or hidden bearish divergence. And what's nice about this is that it's a little mix up from before, and I think this gives you information that might be a little less intuitive. If anyone thinks divergence is intuitive to begin with, I think this is more intuitive, so this should be easier for you. In the bullish case, we're again going to see price set a low, rally, set a higher low, and continue rallying. Lows coming up. We're looking at the lows because we're looking for bullish. And our oscillator, we're going to see set a low, swing up, and then set a lower low. And what's nice about this is I said something about, you know, it always seems like divergence is so pessimistic. It's always against what's going on. I don't like it. And what's nice is continuation divergence doesn't fall under that. It's looking for continuation of trend as opposed to what we're just looking at, which is looking for a reversal of trend. So hidden bearish divergence, what is that? Again, looking at the highs. Price sets a high, pulls back, sets a lower high. And our oscillator is doing the opposite of over here. It is setting a high, pulling back, and setting a higher high. And I think these ones are just a lot more, I feel like the hidden ones are more intuitive. In my own opinion. Because, there we go. I'm not actually even sure why I feel they're more intuitive. I just do. Maybe you guys can give me your thoughts. They just feel more logical. Or maybe it's because when you get signals from these, it is called hidden divergence. Maybe it just feels, I don't know, it just feels better. This is my favorite type of divergence, is hidden. And I feel like almost every time I talk about divergence, I'm really talking about hidden divergence. Don't know why. I guess it's something to do with, so in hidden bullish divergence, you have a lower low, and then a pullback, and then a higher low. And you see your oscillator saying, no, selling is getting more powerful, but price isn't reflecting that. Price is saying, yeah, well, maybe selling's getting more intense, but you're not able to bring the price down. So maybe it's because it's showing exhaustion in markets, and I feel like exhaustion is a very valuable thing to be able to identify. That's probably what it is. Okay, so those are our two types. That's pretty much the full rundown. We have reversal divergence, class A, B, and C, or strong, medium, and weak. We have bullish and bearish, and we have continuation divergence, or hidden bullish divergence and hidden bearish divergence. And so I said earlier that I have a little, you guys, I love to offer you things that I can't find from resources, information that it's not secret information. It just seems that maybe people don't know how to explain it this way or never thought of it. I don't know. But I have something I wanted to share with you guys. So I feel like this can be really confusing when you start, because you guys may be always looking for differences. It can be confusing, and especially every explanation I've ever seen of this never includes this one part of it. And so let me just freestyle this. I thought of this while I was doing this, so I don't have it planned out. But let me see how well I can do. So when we don't see these divergences, there's going to be times where we see price move higher and then higher high, and we see our oscillator do the same thing. Or we see price move low instead of lower low, and we see our oscillator again doing the same thing. And this seems to never be covered when I look at anything to do with divergence. Never seems to be covered. And you know what? This is what you see almost all the time. Let me add some lines here so it's a little more organized. Great. Bunch of new colors. I think this is really important because this is what you see, I don't know, maybe the majority of the time. And every explanation of divergence I've ever seen has never covered this. And I don't understand why. So let's take it over here to the bullish side. We have price moving up, pulling back, making a higher high. And then we have our oscillator doing the same thing. You know, this is what you would expect to see. Or in bearish, same thing. Low, oscillator, lower, low. And I don't know, it just is never covered. And so you guys are going to get, in my opinion, the first time I've ever seen this covered in any kind of divergence explanation. Turn these red just because my OCD. There we go. So what do we have here? You know, if you look at a chart, and today as we look at charts, I'll try to point this out to make it easy for everybody else to notice. What do we have? Because this is probably the most likely scenario in any price action, is we see price and oscillator agreeing. I'd say maybe at least 50% of the time, if not more. What do we have? And the answer is we don't have divergence. No divergence. That seems really simple and stupid to explain, and maybe that is the reason. That could be the reason that that no one includes it. So it really, what it implies is maybe continuation, because we're not seeing any agreements or disagreements, or we're not seeing any disagreements. So potentially that would be continuation. And so the thing that is important in divergence that is not covered is that divergence is really only for spotting reversals, except in the case of hidden divergence, which is potentially trying to spot continuation. But those things are not as common as just seeing this setup. And no one talks about it, and I think that creates mystery. It creates kind of a mystification when people are learning, is they say, oh yeah, okay, I got these patterns. And then they go out there and they see this or this, and they're like, wait, that wasn't covered. So now I'm not sure, maybe I missed something, or maybe I'm stupid. But just no divergence. There's no divergence there. It doesn't guarantee continuation, but it suggests that it basically says look for continuation, because we're not seeing any disagreement. We're not seeing our indicators in our price getting into an argument. We're seeing price and indicators are agreeing. And so that's no divergence. So you know what? Now officially, right now, in Crown Crypto Trading Course, or whatever we want to call it, we're defining the third type of divergence. Right now, here we go. Done. Third type of divergence is no divergence, characterized by highs and lows in price and oscillator agreeing. So here we go, first ever. I'm sure someone else has done this, but I just have never seen it genuinely. And if I've never seen it explained, then chances are you guys haven't either. So hope this was helpful. Certainly will post a picture of this or whatnot somewhere sometime soon, so you guys can have it. And I think that's really it. There's not much else to it. That's all of the divergence that I think there is, and it has all the names. That can definitely get confusing. Strong or class A, interchangeable. I believe there's another word that I can't think of right now, and that's confusing to me. That was confusing to me when I was learning. And I'd hear people refer to, oh, that's strong divergence. And I was like, okay, that makes sense. I know what strong means. And then I hear someone say, that's class C divergence. And I'm like, I don't know what you're talking about. I don't know. I have no idea what that means. Like what class C, what about it is C? Maybe, you know, I'm just speculating here. I wonder if people call hidden divergence class D. And if they don't call it Class D, then maybe that's another term I'm just going to make up right now. So there we go. We made up no divergence in Class D potentially here live on the Tom Crown daily trading show. So dope. All right, I'm glad. That one way better. The first time we did that, man, just did not go. I didn't like it as much. I like this one way more. So thanks for sticking with me through that, guys. We're gonna take a look at Bitcoin here.